Watch how quickly this breaks down on share capital and company equity.
All right, let's get right into it. If you've ever found yourself staring blankly at a balance sheet, totally lost in all that jargon about corporate share structures, you are absolutely in the right place. Today, we're going to completely demystify the architecture of corporate capital. We'll nail down exactly what you need to know about these CSEC accounting principles, and we're going to use some really clear visual breakdowns to take these concepts from kind of confusing to crystal clear.
To kick things off, take a look at the question right here. What is the maximum capital a company can raise from selling shares to the public? Now, this isn't just some hypothetical scenario. This is an actual, historically tricky CSEC exam multiple choice question. So is it issued capital, paid up capital, authorized capital, or subscribed capital? Honestly, it's incredibly easy to second guess yourself here. But by the end of this explainer, answering this won't just be a lucky guess. It's going to be second nature to you.
Okay, let's dive into this. Here is our roadmap for today. First, the corporate capital cup. Second, the dividend payment queue. Third, comparing share types. Fourth, shares versus debentures. And finally, some crucial CSEC exam survival tips. Starting with Section 1, the corporate capital cup. We need to look at the legal limits of raising money.
So before we even look at the shares themselves, we have to understand that when a limited liability company is formed, it doesn't just get to magically start selling an unlimited number of shares to anyone who wants them. No way. There is a heavily regulated legal structure dictating exactly how much capital a company can raise, and it's perfectly illustrated by this measuring cup analogy. Let's walk through this whole journey, from incorporation all the way to actual cash in the bank. Step 1 is authorized capital. Think of this as the size of the cup itself. It is the absolute legal maximum the company is allowed to hold. Step 2 is issued capital, which is the amount of liquid you actually decide to pour into that cup to offer up to the public. Step 3 is subscribed capital. This is the amount the public actually agrees to drink, basically the shares they apply for. And finally, Step 4 is paid up capital, which is the amount actually swallowed. It's the hard, tangible cash the company physically receives from those shareholders.
Let's put a concrete number to this just to lock it in. The source material provides this really great example using a hypothetical company, Caribbean Traders Ltd. Let's say they're registered to issue shares up to a total of $500,000. That specific number, the $500,000, represents their authorized capital. Now, they might decide to only offer or issue, say, $300,000 worth of shares to the public right now. But if a CSEC exam question asks for their maximum capital limit, the answer is always their authorized amount, $500,000. It's the absolute ceiling, regardless of what they're doing on any given Tuesday.
Moving right along to Section 2, the dividend payment queue. Basically, who gets paid first? Now that we've looked at the big picture of how a company limits its capital, let's zoom in on the micro level, the individual shareholders themselves. When a company actually makes a profit, how in the world do they decide who gets their slice of the pie first? Well, think of a company's profit distribution kind of like a queue at an exclusive club. Our preference shareholders, they are the VIPs right at the front of the line. By definition, they're entitled to an agreed rate of dividends, and crucially, they absolutely must receive their payments before anyone else even gets a look. Ordinary shareholders, on the other hand, are standing back in general admission. They wait at the very back of the line and are only entitled to dividends after every single preference shareholder has been fully paid.
All right, Section 3, comparing share types. Let's look at a direct head-to-head.
Now, what's really interesting about this slide is how perfectly it breaks things down. To truly master Section 9 of the CSEC syllabus, you need to recognize these trade-offs instantly. Let's compare preference and ordinary shares across 3 major categories. First up, dividend priority. Like we just said, preference shares get paid first, ordinary shares get the residual, which is just a fancy way of saying whatever's left over. Second, rate of return. Preference shares offer a fixed, agreed-upon rate, while ordinary shares are totally variable. If the company has a massive, blockbuster year, ordinary shareholders can make an absolute fortune. But if it's a bad year, they make nothing. Which leads us directly to the third point, investment risk. Preference shares are lower risk because of that guaranteed VIP priority, while ordinary shares naturally carry a much higher risk.
I really want to emphasize this specific quote from the source material. Ordinary shares represent the residual ownership of the company. That one word, residual, is literally the key to everything here. Ordinary shareholders are the primary owners of the business, yes, but they take on the heaviest burden of risk. Their payout depends entirely on what profit remains after all other obligations are settled. If the pie is fully eaten by the time it reaches the back of the queue, the ordinary shareholders simply go hungry. That's just the reality of the game.
Section 4. Shares versus debentures.
the classic battle of equity versus debt. So far, we've talked extensively about equity, meaning shares that represent actual ownership, but there is another financial instrument out there that students constantly confuse with preference shares on these exams. Take a look at this distinction. Both preference shares and ordinary shares rely completely on the company turning a profit, right? If there's no profit, there are no dividends for anyone. End of story. Debentures, however, are a completely different animal. Debentures are a debt. They carry a fixed rate of interest that is a strict, obligatory legal payment. The company has to pay that interest to debenture holders whether they make a massive, record-breaking profit or suffer a devastating loss. It is the fundamental difference between an owner sharing in the success and a lender demanding their money back.
Finally, Section 5, CSEC Exam Survival Tips. Let's pull this all together. We've mapped out the theory, we've explored the analogies, and we've done the comparisons. Now let's arm you with the ultimate cheat sheet to spot these concepts and secure those exam marks. When you are reading a question, always look for the key words. If you see the words maximum or legal limit, the answer is almost always authorized capital. Do not get tricked into selecting what the company is currently selling. Remember, that's issued capital. Also, keep an eye out for synonyms. Examiners absolutely love to use terms like nominal capital or registered capital. Just remember, those are the exact same thing as authorized capital. And lastly, when you are calculating totals, remember that paid-up capital is the actual physical cash the business has received.
And this brilliantly illustrates one of the most fundamental rules of the Statement of Financial Position. When you're listing out the equity section, the authorized capital is placed right at the top, but merely as an informational note. In standard accounting practice, you must draw a double line under that figure. Actually, scratch that. Think of it more like a giant "do not enter" sign for your calculator. That double line is a vital visual cue. It signals to anyone reading the balance sheet, do not add this number into the mathematical totals. Only the paid-up capital ever gets added to the business's actual working funds.
We've covered a tremendous amount of ground today, from the corporate capital cup all the way to the dividend queue. So the absolute crucial point I want to leave you with is this. Given the trade-off we just explored between the security of those guaranteed VIP dividends and the higher risk, but potentially much higher reward of residual ordinary ownership, which type of share would you personally prefer to hold? It really all comes down to your own appetite for risk. Keep that question in the back of your mind as you continue your journey into corporate finance. Thanks so much for joining me for this explainer, and happy studying.
As always, the link for this study tool is in the description below. Let me know what you think in the comments.